Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Wednesday, the 16th of November. I'm Daniel Lam, your host for the podcast. So if you've been following Cut to the Chase, you would recall that in early last week, I noted that the buzz at the office was definitely picking up, with relationship managers giving very enthusiastic updates to clients on the back of strong moves in the Hang Seng Index. And I noticed that this has been becoming stronger this week. But today, I want to switch gear and talk about Chinese property bonds, which is another heavily hit area over the last 2 years. Now, if we're talking about the lower quality bonds, they have rebounded sharply by roughly 2 times over the past few sessions, from 20 to 40 on the dollar. This is due to the property support measures that we saw this Monday. Now, there were 16 measures, but I will highlight the following. So first of all, the increase of the level of tolerance for potential future NPLs is good for this sector. What they're saying is that as long as the relevant institutions and personnel have done sufficient due diligence, they will be exempted from liabilities. Also, real estate companies' liabilities that will come due within the next 6 months will be extended for 1 more year, and such extension will not lead to downgrading of such loans. Also, there is support for developers to repurchase onshore and offshore bonds. Now, of course, 40 on the dollar is still at a very distressed level. Fundamentally, the sector is still not out of the woods yet. So the question for investors is that would the weakness in China's real estate sector turn into systemic risk? Now, our CIO team's assessment of this is low. Besides the new measures that we talked about, we want to highlight the following. First of all, from the bank's perspective, they're exposed through loan to developers, project loans, and mortgages to home buyers. The estimated exposure via these loans is roughly 1/4 of the bank's total loan book, which the regulator assessed to be reasonable, given the fact that historically, NPL of the sector was a mere 1%. Now, from the perspective of home buyers, they have been suffering from delayed home deliveries in certain cities. Banking regulators have restored market confidence by setting up emergency funds to ensure that project gets delivered promptly. And lastly, from the perspective of real estate developers, the central bank will be able to provide refinancing facilities to buyers of bonds issued by developers. So through these 3 lenses, the risk of a systemic fallout remains low. Having said that, we continue to see better risk reward from higher quality bonds. And it also supports our preference for Asian dollar bond asset class. That's all from me today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.